Welcome to the Perennial Pride Podcast with Tom Sudantri. Here you'll learn new strategies and approaches outside the typical advice to help you gain more control and freedom with your wealth so you can maximize the impact for your families, future generations to come, and the community at large. Every episode is designed to help empower you to determine the best course on your journey to financial freedom. So I want to start today's podcast around sports. I had the pleasure recently watching my son play sports. He's trying out new things, which is what I find a great thing because I want him to be exposed to different environments, different types of teams and individuals. We all know how important that is to develop the idea of teamwork and collaboration. So he's learning a lot of these things through his sports activities, but it's being me growing up playing sports, it's really fun to watch it through his eyes and see how he experiences it all. And to me, a great connection with just life in general. I mean, I call it the game of life before that term and thinking about how we play it. And I think back to my days of playing sports and watching my kids and seeing how they go through it. It's like, how do you give the maximum effort? How do you give all you can to what's going on so that you can walk away from the field and say, I gave everything. I left it all in the field, that expression. And that's something that's always sat with me over my life and certainly my playing days. But it's one thing that's really, I think, helps us to continue to press forward in life in general. How are we giving all the effort we can? And so we can walk away at the end of our lives without any regrets. And that's the last thing that pushes me. It pushes me personally to sort of strive for more because I don't want regrets. And I reflect back reading the book, The 5 Regrets of the Dying, and it really impacted me. We'll have another episode that maybe goes into that deeper, but one of the ones that really sat with me was, I wish I'd had the courage to live a life true to myself, not the life others expected of me. And what I took from that was really one, knowing yourself, what is important to you and what matters, and not letting things externally impact me as much, but also making sure that I gave everything I could. And I didn't walk away with something less than I could have become or given to this world. So I really think that's a really key aspect of what drives me on a daily basis. And hopefully it does for you as you grow in your own education around personal finances or whatever it is you're trying to improve upon. There's a quote from a good friend of mine, Aaron Chapman, who's a mortgage broker who will have him on, I guess, in the near future. He's going out of this world. He's going out hot because he is of the mindset of providing as much as he can while he's here and able to do so. And he's not going to quit till that day comes. So really stuck with me, and it really epitomizes kind of what we're talking about here. And obviously in our lives, as we're striving to become the best and impact as much as we can on this earth, we need resources. And that could be in the form of friends, family, networks that we have built, our education that's come, obviously our wealth and our money. And there are some who maybe believe having a lot of wealth is a bad thing. It's a negative. However, I definitely look at it very differently, and having wealth gives me certainly more options and ability to do more for my family and others around me, but also impact more. And so it's great to have those sorts of resources to be able to lean on and really so I can focus on improving and growing and doing more. And so as we think about our personal finances, the thing that I sort of think about is building wealth, right? What are the ways that people are building wealth? Well, and how do we use our wealth? It's so important because now so we can think short term versus long term. But there's 3 kind of buckets here around wealth I want to share. Is one is around accumulating that wealth, the accumulated wealth. And that's typically, as we're thinking about, we're saving money, we're growing it. We may put something on the side and maybe someday with the hope that we'll get to use it. Hopefully it's there in the amounts that we want and it provides some return. So that's accumulated wealth. Obviously we have to save money to do that so we can invest it. The larger portion where our money goes is to our lifestyle, and whatever that means for you, your housing, the things you get to do in life on a daily basis. So those are all money that's being used today to just support our daily living and the things that we want in our lives. And so you can argue whether it's good use or not, that's all personal, but it's where it allows us to sustain life, enjoy it, hopefully get some fulfillment on a daily basis and maximize our days and hopefully our future wealth. The third bucket of wealth is centered around what we would consider transferred wealth. So this is wealth that may be sometimes even invisible to us. I mean, it's going to other places that maybe are either invisible to us or we just don't really understand and appreciate maybe the magnitude of that wealth. And that's a pretty sizable amount. It could be for many people. And that's where I want to center this conversation because I want to have more of my wealth stay in my world so I can use it for my lifestyle and use it to accumulate and save and invest for my future, as opposed to a lot of it getting away from us. And that transfer of wealth could be a sizable number and potentially hidden from us. And by the way, we are taught to manage our personal finances. And I think about it, this is an analogy I always use is it's like a pail that you're filling up with water. However, the pail has substantial amounts of holes in it. So you're trying to fill up this bucket with, in our world, water or wealth, but it's leaking out in a lot of places. So it's a really tough battle we're facing here. And it makes it very difficult to fill that bucket up to a level that is to our standards or what we want to achieve. And those dollars could be going to a lot of different places, whether it's the government or IRS, could be financial institutions in different ways, whether it be banks, brokerage homes, insurance companies, and certainly corporations. And corporations play a big role in our worlds where we're funding our lives for things that we feel like we need, even though maybe is a want to begin with. Now a luxury becomes a need. So a lot of these people are competing for our dollars and are getting transferred away so that they're not used for our own saving and investing going forward. So here's a very basic example financially how this could work. So imagine you're making $100,000 a year and you're able to save $10,000 a year. That's just 10%. And unfortunately, in today's world, not everyone's able to save that amount. But say you're able to save 10% of that $100,000 of income, that's $10,000. And you deploy that to invest somewhere. And say it earned 8%. Well, that 8% could earn you $800, right? So that's not bad. So here's a second approach. Imagine if you focus some attention on reducing, say, your taxes or interest you're paying to financial institutions, and you can shave it by 5% based on what an average person pays in taxes and interest and financing charges elsewhere. You could save nearly $3,200 just by if you were to identify ways to trim those costs, that you could save 4 times what you've earned on the money you saved in the first scenario. And it will reduce your risk and you can keep more of that money moving and growing. And that becomes a perpetual thing because hopefully you can save that every single year going forward. So these are really powerful because those are where all the big numbers of money that's getting away from us, we can just shave pieces of that and start using that to save and invest and grow our assets to build us more wealth and more income that could have massive impacts to our financial power and freedom. And we could do that even with less risk. So what I want to cover in more detail today is where some of these, what I would consider wealth eroders, things that are really taking away our wealth and they're transferring them elsewhere. And we're going to do more of just a flyover just to give you a sense of them. Spend a little bit more time as we move along here and explaining them in more detail, have specific options that people could use to consider to address them. But we'll go through it as this sort of summary version of it, just to give you a sense of the types of things. So one of the big things, and we see it now in this day and age, it's becoming a much more bigger issue for folks, is inflation. Inflation is a significant wealth eroder, and anyone knows anything about inflation, obviously you're losing the purchasing power of your dollars. Things are costing more, so your dollars don't go as far. And so pretty basic in that level. And our Federal Reserve are they're targeting inflation. They want it to grow at 2-3% a year. They feel that's healthy for the economy to continually grow. Unfortunately, what we're dealing with today is much in this day and age, much more substantial, and it's really causing some pain, certainly for a lot of Americans in this country to be able to afford just to live. And so from that perspective, we really need to figure out how we can combat this and make sure our resources that we are deploying in saving, investing can try to outpace it. So imagine for a second, though, if this very simple example, if we had a 3% inflation rate, which today we have much higher, and you're saving, say, money in a bank that's earning less than 1%, you could lose literally half of your purchasing power over a 20-year period. So it can have a very large impact to your ability to just live life. And so that money's eroding without actually doing anything. It's a constant loss. And that inflation rate is even, I think, understated when we look at things like shadow stats and such. But the inflation rate is still at minimum and targeted to be 3-4% or whatever, 2-3%, sorry. And so we still got to get ahead of that. So, for example, back to storage of wealth, like if you're storing in banks and it's staying there for long periods of time, we've got to explore maybe alternative ways where to store it. And that's where our family bank concept comes in. And there's episodes on that to give you a flavor of where you can store wealth that's liquid and safe. And then how would types of investments that actually benefit from inflation, such as real estate, where you may be leveraging a fixed rate mortgage to help fund your investments that's flat, that gets cheaper every single year you own that debt. So the debt in that scenario, the debt becomes the asset because that fixed rate payment you have to make on your home or rental property is actually getting cheaper every year you own it. So strategically using debt to secure assets that hopefully will also appreciate, like real estate with inflation, then you really can have a really strong combination with it too. And that doesn't even factor in maybe some tax savings in that, but that just gives you a flavor for that. So we'll have much more on that on future episodes. A second area that many are losing wealth, and it's one of those slow drips that over a long period of time can have significant impacts, are fees as relates to managed accounts in the stock market or stocks, bonds, mutual funds, and your 401k, IRA, or even brokerage accounts. That, something as typical as like a 1% fee to manage those accounts is not unusual. And some people are doing it themselves using low cost options like index funds and such, but there are ones that are playing 1%, maybe even as high as 2-3% to manage that wealth and those investments. Now, I'm not saying that's a bad thing. It depends on if you feel like you're getting value for those fees that the advisor is charging you. If you are, then that's great. But that you just have to evaluate that. What's the value of that? Because take, for example, if you had a 1% fee over, say 25 years, an average fee, 1%, you could literally lose up to 20 to 25% of the value of your portfolio just by the fee, because not only do you lose the fee, but the ability of the dollars in there to compound as well gets sort of diminished. So your assets can't, and we know that the compounding happens on the tail end. So having less to kind of grow and compound on itself is really the biggest factor in that, and losing that value. Most people, I don't think, always appreciate this as much as market losses and volatility. We've been taught that the market does what it does and it's going to go through its ups and downs, but in the long run, it only goes one direction. And so just wait it out, think long-term. And listen, I think when you look historically around the market, yeah, you can see that it has gone up over long periods of time, but we've had in the last 20 some odd years, some significant downturns. And the reality is you could hear things like the average rate of return. You hear like a Dave Ramsey say 12%. And we always get that. And you expect it's almost like a guarantee. Well, when you look at the ups and downs of the market, the losses actually impact things a lot worse than the gains. So the one example, say you had $10,000 and you had a 50% loss. I know this is, that was pretty dramatic to have something like that. But say it dropped from $10,000 to $5,000. and say that same investment grew by 50%. So you would think on average you would be back to even. Well, in that scenario, the 50% gain only got you back to $7,500, which results in really 25% loss of your money in that dramatic example. And that doesn't even count for any fees that are associated with that. So that's what shows you even the average, when they average these things out there, it's a little deceptive because the losses are going to have a much larger impact on your actual returns over the long run. Now, so it's just something to be mindful of, that those things are going to happen. So that's why it is very important to have things that maybe go up and only go up, because losses are really can be impactful. The fourth hidden wealth eroder I think is key to consider is, which we talked about earlier in this podcast, is around interest. Interest we're using to finance our lives. Now we've now grown into an economy and frankly a world where we rely on debt to fund our lives, to help fulfill investments. And so it can be used strategically to really build wealth if you understand how to use it. But we actually, across America, we use a lot of debt to bring forward income to help us live a life, purchase things that we may not be able to fund ourselves, like buying a home or with cash rate, funding college or paying for vacation, whatever it is. We're just pulling forward money and we're obviously paying interest to that. And that comes with a cost, right? Everyone can explicitly see that, and it's big. So alternatively, you can use cash, and cash in today's age, cash isn't really earning all that much. So it doesn't feel like anything, but if we can find better places to put it, paying in cash actually has a cost too, because we lose that interest, the ability to earn from that going forward. So whatever you purchase for, whether you say pay for cash for your education, then that money stops earning going forward for decades, depending on where you are. So the saying, it goes, whether you pay cash or take on a loan and pay, you're always paying interest in some fashion. And so that's where the strategic use of debt and within the family banking environment is a great example where you could leverage someone else's money and allow your money to continue to grow. A third option. So have your money never lose, never go in any direction downward, and strategically borrow, say, from a life insurance company or even a bank to leverage and finance your life, your purchases, your investments, and control that debt and allow your assets to continually grow and compound over long periods of time. And you can control that. So it's just a different method that can be very advantageous and efficient in terms of managing debt, and understanding that is so key. So, and we had prior episode on the family bank, and we're going to have more detailed discussions around that, because I think it's a massively beneficial foundational piece for people's financial lives. And the fifth hidden wealth eroder I want to chat about is around, which, well, we all know is there's two things of certain in life. This is back to Ben Franklin, is death and taxes. Well, taxes is part of our lives. It was supposed to be an experiment and temporary back in 1913. Well, it is part of our lives, and it consumes most of our expenses. Our biggest expense in life is taxes, unless you don't have a lot of money. And so taxes are a huge component, whether how we're building up our wealth, minimizing some of that so we can keep more of it. And even in retirement or down the road, if you're transitioning to a new role, you don't like the word retirement, that taxes are going to be a big part of that. And so we have to think about how we can strategically minimize taxes, eliminate them where we can, and not just postpone them. In the world of the typical financial advice is plow as much money in you can into deferred accounts like 401ks and IRAs, and you're going to be, have lower taxes in retirement. So, you're going to win on taxes in the end. It's possible. It surely is. And there are certainly strategic reasons to put money in accounts like this. But unfortunately, what we're seeing is people are putting way too much in there, and it's creating a big tax liability that's going to come to roost when people want to use their money and live it. They're going to feel like it's going to feel bad to get those monies out with the taxes, so they don't use as much. So this is, to me, it reduces the freedom and use of our dollars. So again, I'm not saying don't use them. It's just using them strategically across other assets. But this is where thinking about how we can partner better with the IRS and not just be a passive investor with them, but partner with them in a more active way. What is the tax code is designed to help us incent people to do things like create businesses, employ people, house people, protect our families, save for retirement. That's one part, and give to charities. These are just examples, and become energy independent by investing in things like oil and gas. So there are ways that we can partner better with the IRS, reduce our taxes, and actually build our wealth with the same investment. And those are things that as we wear along with the podcast, we're going to share a lot of different examples of those to pique your interest. But there's a lot of ways that we can actually make the IRS our friends in our wealth building, as opposed to taking our wealth away. And every dollar we pay in tax today is a loss going forward. I consider it a loss, and it's a loss going forward because we can't use those dollars. And that's what goes into the last, to me, the biggest wealth eroder of all is opportunity costs. And that one, it doesn't come off and we don't see it. We don't see it as a specific loss anywhere, but it's really a major impact to our wealth building, because every dollar that leaves our world stops working for us forever. And that, when I say forever, not only our lifetime, but even the generations that come after us, the impact it could have on them. So, my hope is around our wealth, certainly for my family's wealth building, is we're building it not just for my life on this earth, but for generations of my family going forward. So I'm thinking that long term, and every dollar that gets consumed or lost and leaves our world is no longer going to be able to serve my family and future generations to come, at least from my control. So it's a really massive one, but it just doesn't come up on anyone's income statement, but it's significant. And we got to account for that as we're making decisions around our personal finances. So that's all I want to cover today. I know it was quite a bit, and, I just want to give you a flavor for them. And certainly I would highly encourage you to reach out to your advisors, if you have one now, to talk through those and investigate, are any of these wealth eroders impacting your ability today to save more and invest more? And I wrote a short little guide on it, and I'll put a link to it in the show notes. You can grab that short little 20-page guide that I wrote that goes in a little bit more detail than what I shared here, but gives you a good starting point to evaluate ways to combat some of these wealth eroders that really can compound in a negative way the loss of their wealth. So I hope this has been a powerful tool and information for you in education as you think about your personal finances, and gives you some ways to potentially plug those leaks so you can have more, you keep more, and have more of your dollars working for you on your path to financial freedom. Take care, and we'll see you on the next Perennial Pride podcast. Thank you for being with us here today on the Perennial Pride podcast. It's an honor to be a small part of your journey to financial freedom. If you gained new insight on today's episode, please follow us on your favorite podcast app, such as Apple or Spotify, and follow us on our YouTube and Facebook pages. Also, we always love feedback on helping to improve what we're doing here, so please provide in comments and questions so we can make this podcast even more helpful for you.